Welcome back to Alpha Recap. I'm so glad you tuned in. Markets closed for the long weekend, and we've got a packed recap of what moved and why across the sectors. As always, if you have questions, you can reach us at stockalpha.ai, and you can submit questions there anytime.
Great to be here. Lots to unpack from a week where policy headlines and a few big transactions really shaped the tape.
Okay, quick headline rundown for listeners. Materials, technology, and energy finished the day as selective outperformers, while crypto, healthcare, and communications lagged. Tell us why that happened. Start with the big policy moves.
Sure, two policy items were especially visible. First, a federal court ordered the release of $5 billion in NEVI funds for EV charging. That was a concrete stimulus for charging deployment. Second, the FDIC issued conditional approvals for two major automakers to form industrial loan companies. That's a structural move that touches vehicle finance and deposits. Both items cut across multiple sectors and created clear winners and losers.
$5 billion. That's real money. Walk me through the practical impact on energy and autos.
With those NEVI funds released, state and local procurement timelines got unblocked. Practically, that accelerated bid activity for charging equipment, installation, and grid integration. So companies that make charging hardware or install and service stations saw a visible demand impulse. For automakers, the industrial loan company approvals, if followed through, could let them control more of the finance stack, gather deposits, and influence lending spreads. That's potentially a long game, but it was treated as a near-term catalyst for auto suppliers and captive finance models.
So procurement announcements and RFPs could start rolling. That's exciting for infrastructure players. Speaking of supply chains, materials were up. There was a landmark rare earths deal and talk about tungsten and scandium. What changed there?
Investors responded to real, tangible steps to secure critical minerals. The rare earths transaction signaled renewed willingness to consolidate supply chains, and growing interest in tungsten and scandium showed demand beyond just the headline metal names. Importantly, recycling capacity and new drilling programs gave miners and processors near-term catalysts, which meant processors and recyclers with offtake contracts were the preferred exposure, not speculative explorers with multi-year timelines.
So, you were favoring companies that were closer to cash flow, processors and recyclers, over the high-risk explorers. That's a nice nuance investors often miss.
Exactly. Processing and recycling show up as contractual revenues sooner, and with defense, EV, and renewable equipment demand, depending on these inputs, there was a reason to rotate capital into those names.
Let's shift to technology. AI kept some names buoyant. What kept tech selective but constructive?
AI demand remained concentrated in a handful of winners. OpenAI's enterprise push and partnerships, including federal deployments, helped enterprise AI vendors and cloud infrastructure names. On the hardware side, memory and storage demand ticked up, which showed through commentary around companies like SanDisk and Western Digital, but at the same time, platform outages and privacy questions weighed on other big tech names, so the story was very much about picking the right exposure to AI infrastructure and enterprise software rather than owning the whole sector.
I love that. Infrastructure and enterprise wins, consumer platforms with PR or outage risk lagging. You mentioned memory and storage. That's where the rubber meets the road for AI compute, right?
Yes, generative AI is compute hungry. Cloud providers, GPU supply chains, and storage and memory vendors are the parts of the chain that translate AI adoption into predictable revenues. Investors rewarded those segments this week.
Energy also outperformed thanks to NEVI and EV truck momentum. Any specifics there?
Beyond the NEVI funds, product wins and deployments mattered. We saw momentum in EV truck sales and new charging deployments, including activity from automakers and partners. That gave companies that provide chargers and integration services a practical tailwind. Again, a case where policy flowed into procurement and into revenue visibility for specific vendors.
All right, now to the underperformers. Crypto had a rough week. Walk us through the mix of security moves and capital outflows.
It was a mixed bag. On the security front, Ethereum doubled down on post-quantum defenses by launching a $2 million prize program. That was a proactive, long-term trade aimed at hardening the protocol. But despite that, crypto ETF flows recorded their weakest week since February 2025. and exchange and custody providers flagged banking and competitive pressures. So you had security narratives that mattered for the long term, but capital flight and regulatory uncertainty drove near-term technical weakness.
$2 million for a security prize. That's signaling seriousness. But flows trump the narrative in the short run. What did firms like Coinbase say?
Exchanges warned that banks see crypto as more of a competitor, which complicates custody and banking relationships. Those frictions made investors cautious about exchange and custody providers until flows stabilized and the regulatory picture clarified.
Healthcare was another weak area. I know there were several headline risks this week. Give listeners the layman's version of why sentiment cooled.
There were three headline pressures: a pause in some public health funding, an infant botulism outbreak, and an indictment of a device maker. Those kinds of stories create short-term uncertainty. They can slow elective procedures, delay reimbursements, and invite regulatory scrutiny. Long-term, digital health and AI in healthcare remain structural growth stories, but short-term investors punish names with legal or headline exposure.
Pretty stark contrast. Long-term innovation versus near-term headline sensitivity. Communications and live events also had trouble, right?
Yes, safety and PR incidents at major festivals and a shooting that interrupted live events reduced enthusiasm for media and event operators. Investors are still sensitive to any operational disruption that can hit ticketing and sponsorship revenues.
You described a set of cross-sector themes in the note. Can you summarize the most important ones in plain English?
Sure, 5 quick themes. 1. Policy as a price driver. The NEVI funds and FDIC approvals were not just headlines, they created real demand. 2. Supply chain reconfiguration. Rare minerals and onshoring are reshaping materials and industrials. 3. AI and cloud are amplifying dispersion within tech. Some names captured the growth, others got hit by platform risks. 4. Regulatory friction and capital flows in crypto and finance. ETF flows and non-bank entrants changed dynamics. 5. Real economy stories versus headline risk. Healthcare and communications were driven by headlines rather than fundamentals this week.
That's a helpful framework. Now, listeners always want practical moves. You had a list of actionable insights. Let's go through them one by one. First up, materials.
For materials, favor companies with processing or recycling exposure over pure explorers. Rotate incremental capital into mid-cap miners and processors that have off-take contracts or recycling assets. The rationale is that the rare earths deal and renewed interest in tungsten and scandium should produce multi-quarter contracting and price support for firms that can supply now.
Next, tech and AI.
Tilt into AI-exposed names, but manage platform risk. Increase exposure to infrastructure providers, compute, memory and storage, and enterprise AI vendors, while trimming or hedging platform names that face privacy or outage risk. Hardware and enterprise software are capturing durable revenue from AI monetization.
Energy?
Be selective. Favor EV infrastructure winners and service providers. The NEVI funds release supported procurement cycles for chargers and installation, so companies with direct exposure to charging equipment, installation, and grid integration had clearer revenue visibility than broad oil names that weren't tied to NEVI.
Crypto strategy?
Use a two-track approach. Reduce directional exposure to broad crypto spot while favoring infrastructure and security plays and regulated on-ramps. Security investments like the $2 million prize are important, but they don't immediately stop outflows. Custody providers with strong bank relationships could emerge stronger over time.
Healthcare advice?
Focus on defensive healthcare names with clear cash flows and limited headline risk. Favor medical device companies with long replacement cycles and large pharmaceutical firms with diversified pipelines. Be cautious with small caps facing litigation or public health headlines.
And real estate and utilities?
In real estate, favor segments benefiting from lower mortgage rates near 6%, growth metros and conversion plays. In utilities, lean toward companies integrating solar and storage and those with grid management software. Both sectors were sensitive to rates and local regulation, so active monitoring was key.
Those were actionable and clear. Thank you. What were the main risk factors to watch next week that could flip this narrative?
4 to watch. 1. Macro and Fed commentary. Any surprise on inflation prints or hawkish comments could reverse mortgage rate improvements and pressure rate-sensitive sectors. 2. Regulatory moves. Look for developments on crypto frameworks in Europe and the US, as well as any FDIC follow-through on industrial loan company approvals. 3. NEVI procurement timelines. State DOTs set the pace on how quickly those funds reached contractors. And 4. Headline shocks. Public health incidents or legal actions could trigger sudden risk-off moves in healthcare and communications.
Practical trade ideas. You mentioned a few names to watch, but without tickers, right? Tell listeners what to watch on the long and cautious lists.
Right. On the long side, look at charging infrastructure companies and NEVI exposed contractors, select materials processors, and recyclers with off-take agreements, and enterprise AI infrastructure providers like cloud and memory storage vendors. On the cautious side, be careful with broad crypto spot exposure until ETF flows stabilize, small-cap healthcare names with legal overhangs, and live event operators exposed to PR and safety incidents. Also monitor Ford and General Motors for any ILC follow-through and filings, and watch Coinbase for liquidity and banking updates.
Fantastic. Before we wrap, give listeners 3 clear takeaways they can remember.
1. Policy mattered this week. The NEVI funds release and FDIC approvals created concrete demand for specific subsectors. 2. Be selective. Favor companies with contractable revenue and visible cash flows like processors, EV infrastructure providers, and enterprise AI suppliers. 3. Headline risk still bites. Crypto and healthcare were driven by flows and headlines, so manage position sizes and keep liquidity for quick adjustments.
Great closing points. Thanks so much for the context, Drew. Really clarified how these headlines fed into sector moves.
My pleasure. It was a week of selective strength, and staying focused on cash flows and policy timelines should help investors separate durable winners from headline-driven losers.
Okay, listeners, that's our recap. If you have questions about anything we covered today, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Have a great long weekend, and we'll be back after the markets reopen to see how these stories played out.